So like 4:15.
4:15?
Okay.
Okay. Do you want me to introduce the panel or you can just go ahead? Thank you.
Thank you, colleagues. Welcome back. Good afternoon. I hope you enjoyed the morning with us. My name is Massimiliano Riva. I am the investment advisor to the UN Joint ESG Fund. And let me add, it's a personal pleasure to be here. And after working for 2 years remotely with many of you, it's really a pleasure to meet on person after so many Zoom friends we have made in the past years. Someone may not like me, but still it will be have a chance to have some fun in addition to work. So thanks again, everyone, to join the panel, particularly with our partners from private sector and the FIs. We have as for our very inspiring speech at the beginning of the conference, this panel goes into the role of what are mainstream financial institutions, like commercial banks, but also different type of private equity and institutional investors, how they're embracing the challenge of integrating ESG, environmental and social and governance into their practices, into their business practices, and as well as to enter the world of impact, right? The word that was mentioned before. But we started actually this today's summit with the bank. So it is possible to do it. We have leaders in Africa, from Africa, that are trying to respond to the challenge. So the question for our distinguished panel, which I will introduce in a second, is really what are the challenges, what are the opportunities, what are the strategies, and what are the reflection about moving what is maybe still perceived by many as a small and niche market, the market of philanthropy, of NGO, of impact-driven forerunners and some inspirational leaders, to what is actually a mainstream standard financing product that are of interest to you, to your pension funds, to your friends for direct investment, for making even money out of your saving. So that is a bit question how we moved from niche to mainstream, and we'll ask this question to a very diverse panel here today with us. And let me quickly introduce them, and then start with a round of introduction. First is Massimo Lanza, who has been working for banks for over 15 years in several senior and management roles, and is now active as a board member in 2 banks, an asset management company, a private equity, and a social housing institution. So a wealth of experience from very senior leader in banking, particularly working in Europe, US, and Italy. I have next to him is Teddy, that you have seen in the previous panel, and it's a very interesting link to what has happened before. So Teddy is an African investment advisor for the FC, and also will speak about the role of development finance institutions in steering and supporting commercial banks and institutional investors in their journey. We had next to Teddy, Godfrey Mambo. He's a senior corporate banker, corporate lending Africa at Rabobank, which is, as you may know, is a leading bank in Europe with several operations in Africa that work particularly on financing solutions for the food and agri-food sectors that we have heard well this morning, and working in different type of products like carbon credit and other type of transaction. He also worked at different roles with the Bank of Africa and United Bank of Africa and Standard Chartered before. Next to him, we have Davis, that is coming from Davis Muzozo, if I pronounce it correctly, who is the head of alternative investment from Old Mutual Zimbabwe, who is also one of our partners in one of the catalytic investment in programs that the Joint ESG Fund support. Then we have last but not least, Pauline, who is currently the CEO and the head of the Stanbic Kenya Foundation. He has a very long experience in international development, over 20 years of experience across impact investing, private sector development, and strategic partnership. We also have two brilliant colleagues that could not join in person, but are connected via internet, and we hope it works. I might have to say we didn't have too much luck this morning, but we hope that we improved through the day. This is Jean-Paul Adam, who is the Director of Technology, Climate Change and Natural Resources Management in the United Nations Economic Commission for Africa. He previously served in several roles in the cabinet position in the government of Seychelles, including as Minister of Finance, Trade, and the Blue Economy. And he negotiated at that time very interesting, innovative financing solution for the Seychelles. And Marie-Laure Bourat is a head of norms and methodologies at Société Générale, where he led a new streams of ESG by design, as is called, as a very transformative project in a very large bank and financial conglomerate, one of the larger in Europe, with over 20 years of experience in international and emerging markets across different functions on the financial market. So without further ado, let me open the structure of the panel with first of an international perspective, and I will on the core question of moving from niche to mainstream and different strategies that banks and large commercial institutions can utilize to integrate the SDGs. So we'll have first Massimo and then Marie-Laure to give us their perspective and reflection. So over to you, Massimo, with your initial reflections and thoughts about the topic of the day. Thank you.
Thank you, Max. I'm perfectly aware that the first session after lunch is the most difficult one in any program. I promise I will be brief, and I will go straight to the point that our panel is asked to present, which is how can we mobilize private investments, let me stress private investments, into impact private SDG, ESG, and impact investments from niche to mainstream. I am, as Max said, what we call in Italy a street guy, which means that I'm not an expert, I'm not an academic, but I'm a person who has spent a lot of his time on the streets of banking, private equity, and asset management. And so what I'm going to tell you and what I'm going to propose as possible solutions come from my street experience. The good news that I want to start with in my presentation is the fact that impact investing has become a big thing in Europe and particularly in Italy. Is not only fashionable, but it's material. At the end of 2021, the amount of investments in, let's say, impact funds is actually a wider definition, was 1.3 trillion euros. And the growth is expected to be explosive. Italy, as you know, is a country which has a very high rate of savings, and asset management is one of the most important financial industries in the country. To my knowledge, none of this money goes to Africa. None of this money goes to, let's say, emerging, or probably some goes to emerging countries, but very little goes to countries which are not considered even emerging. So far, investments into impact funds in Africa come from charities or from family offices. So the question is, how can we mobilize some of these huge resources? How can we have investors, private investors, retail investors, who incidentally have a very positive approach to impact. They have a very positive approach to the idea of helping countries to build their economy. How can we do that? I don't have, of course, magic answers. I have some answers, and I have to say that I was very pleased this morning attending the very interesting panels which took place to discover that basically the ideas that I had were all present in the panels. So what I'm going to do is to recap and probably a bit focus on the action more than going through the various analysis and the issues of moving investments to this area. First of all, let me stress what I consider a very important aspect of the growth of an economy, which is the role of small and medium enterprises. I think that, of course, infrastructures and larger companies, larger corporations investing are important, but I think that for the growth of an economy, SMEs are very important. My country, Italy, is a very clear example. Italy came out of the Second World War as a destroyed country, and it was mostly thanks to SMEs that its economy was able to grow and to reconstruct the entire country. The SMEs play a very important role under various reasons. They definitely impact, particularly from a labor point of view. And they are very important also in the chain, in the supply chain. And they are very important also for the large investments. So I will start from here. How can we start from the SMEs, and how can we foster the growth of SMEs? My answer is private equity. Private equity is, in my opinion, the best tool to have SMEs grow in a country, in an economy. Private equity shows what I call the virtuous circle, which is invest, manage, and exit, which is very important because it basically represents a due diligence, for any investment. It fosters sustainability. It fosters governance, good governance. It fosters the ethics and clear accounting, which are very important, of course, for the growth of any economy. It represents also a multiplying factor in the economy. It's an accelerator. It's the typical catalyst. If it starts and has good results, it is really very important for an acceleration of the economy. It also, let's say, covers the gap with banking and with asset managers. Banking is very important in private equity, and the additional due diligence that the private equity conducts on the investment it represents a sort of, not a guarantee, but certainly a very good starting point for a bank to lend money. So how can we have a private equity how can we have an investment in private equity? The formula is basically the formula that all of you know. We have the investors, we have investors in funds, which then invest in private equity, which in turn invest in the small and medium-sized companies. So nothing new under the sky. The problem is how can we have money invested in private equity? I recently read a very good note which was prepared by our friends of Bamboo Capital Partners about a bond issue, a large bond issue, which would invest in private equity. And of course, it is very interesting, provided that, and we go back to the initial point, provided that we go back to the possibility of having investors in Italy or in other countries to invest in the bond issues. Naturally, if you put a guarantee of a major international bank, that's pretty easy. So what we really have to do is to make sure that the bond issue comes without a guarantee, comes based on the validity of its investments. And when we talk about investments of SMEs, particularly those investments which are affected to a private equity, we're talking about good business. We're talking about profitable business. We're not talking about donation or else, or philanthropic purposes. Now, how can we de-risk the investment? That is the major problem. Particularly, how can we go beyond the country of risk, which is the major barrier for any asset manager in Italy to invest into a bond issue or any other type of investments of this type. This morning we've heard many possible solutions. You don't have one single solution, but you have several solutions which can help. You can have the first loss. You can have, the DFIs coming at a certain level, mezzanine level or equity level. I'm not going to repeat them because you are perfectly knowledgeable about this. But what we have to do is really to bring a type of investment which is based on the quality of its performance. In my career, I remember at the very beginning of my banking career that products like high yield bonds or other types of very risky investments were impossible to imagine, and they've become real because at the end there was the possibility of pricing correctly the risk. I understand that it is very difficult to price the risk in this case because we don't have a history, but we have to start. That's the point. If we start and we start the virtuous circle of bringing an investment and show that this investment has performed well, I think that would be the very beginning of a good path. Network of private equity. I think that this is the second area where we should really focus. We need a network, a base of private equities, many private equities, all working based on the merit of the investment, based on a good and profitable business. That is the rule. How can we foster the growth of private equity? We have to create a generation of private equity professionals. That, in my opinion, is the important thing. But we also have to work on capacity building. This word came this morning very clearly during one of the panels, during the second big panel. And I think it is very, very important. Building capacity, building culture. Not many asset managers. When I checked with my colleagues of asset management in Italy, and I said, how can we approach this problem? Nobody had a real answer, or the answers were futile, like saying, it's a matter of guarantee, it's a matter of country risk. So we also have to build culture in this sense. Of course, government legislation is very important. It's also very important to have infrastructures, but I don't have to say this. You know this perfectly. Conclusions. Conclusions start from a point, an issue which was covered this morning, which was a sort of competition among the actors on the field. An issue of lack of working together. This, I think, is true many, many times, particularly when you want to approach and address a very difficult problem, and particularly a new problem. I think that a plan, a big plan, should be launched. A big plan which addresses the issues that we have covered during the panel of this morning, the panels of this morning, and that I recapped now very briefly. Could be the United Nations, be the super partners catalyst of a program like this, of a plan like this. I think that a plan that would call professionals from the various private equity firms and asset management firms, which are all over the developed countries, could be really with very clear sets goals, could help in this process. But don't forget one thing to complete my presentation. The resources are there. The potential market is enormous. Let's not miss the opportunity. Let's not leave the markets to greenwashing, which, as you know, is very common, unfortunately, in the developed markets. Thank you.
Thank you, Massimo. And I'll pass geographically now the mic to France, to Société Générale, to hear a bit of another perspective on integrating ESG and impact considerations. So over to you, Marie-Laure, to give your initial remarks, and please unmute yourself. I hope the tech works from now on.
Can you hear me properly?
Yes, actually very well. Please go ahead.
Okay, that's fantastic. Thank you, both Massimos, for your introductions, and I send you a very warm welcome from Lyon this afternoon, where the weather is also fantastic. So from my side, I've been asked to give you a little bit of a background as well on the regulatory framework in which we operate in Europe. ESG has become a regulatory matter where I am sitting, and the European Commission has taken a lot of leadership in that. The taxonomy regulation, as we call it, just the taxonomy, is the pivotal official text defining the criteria with which an economic activity can be defined as qualifying as environmentally sustainable or not. It is a text that is valid for investors, for corporates, for issuers, for project promoters, and it is likely to become a sort of a new alphabet in Europe. The objectives of the taxonomy all have an echo with what you are trying to achieve today in Kenya. I'm quoting some of them. Redirecting capital flows to help generate sustainable and inclusive growth. Enabling scaling up of sustainable investment. Provide uniform criteria so that transparency is increased, and there is again an echo to Massimo number 2, no green or social washing of any sort. So the good news is the EU is fully aligned with the United Nations, with the SDGs, with the SDG funds. And this regulation is being implemented across the financial sector and will have a central role in the disclosures of what activities we finance, and if these activities are sustainable, taxonomy compliant, with growing peer pressure on comparison once the disclosure rules will be fully aligned. This is going to come progressively. But there is also pressure from society, from stakeholders, from shareholders, from investors, from politics, from NGOs, and of course from multilateral agencies like the UN, so that we take more on emerging markets. Now the taxonomy has its limitation. Only European corporates are subject to disclosure obligations. The number of the disclosing entities will be growing with the move to CSRD, but for the moment, the work that Société Générale, for instance, does through its retail bank subsidiaries in Africa, for instance, is not being recognized in the taxonomy. It's a bit disappointing, honestly. It's disappointing for our colleagues who work on the ground every day as well. The same thing for the significant influence of European banks in export finance. A lot of governments in Africa do benefit from export finance, but all transactions with local governments, with ministries of finance, whether they are in Africa, Asia, Europe, North America, are not taken into account. There are also green supporting factors at the Basel Committee level, but at the end of the day, any supporting factor on banking capital should be regarded as something related to risks. And being green doesn't mean being less risky. So this is something that we have to pay very attention to. So do we believe that regulatory incentive will target more private sector bank money towards Africa and towards emerging markets? I believe it will. It will certainly help raising standards, raising awareness in the manner in which we all do business, and in doing so, it will eventually be reflected in other geographies and not only in Europe. Investors everywhere in the world now want to know what is at stake, how their money is used, and be informed on good practices. They want information and they want proper impacts being measured and reported. And the investment planet is global these days. Still, developing markets are perceived as riskier. The pandemic has recently contributed to only demonstrate or prove that lower GDP countries prove more vulnerable than deep pocket economies with easier access to capital markets. And with more focus on climate risk in our own models that are also pushed by the regulators, physical risks might even become more underlined. So now regulation will help, but it is not sufficient. So what can you do? What can we do? I very much echo the remarks of the first speaker. SMEs, I totally agree. Venture capitalism, I totally agree. Expertise needs to be developed, but in my mind, there's been a lot of expertise already. What sometimes misses is coaching of SMEs. Beyond VC, beyond capital, it's really finding good projects. Banks need good risk. We need good risk, not because we are risk adverse, but because we are regulated in this way. And risks need to be measured. It's difficult when we don't have statistics, it has been mentioned, but if we can prevent risk, if we can mitigate risk adequately, it will help. I disagree a little bit more with Massimo, but that's what a panel is for, is also to bring different ideas. I think grants can help. They can help even if it has proven difficult. They need to be thought maybe differently. We are a great believer that the private sector can foster this virtuous circle of development, but sometimes even before guarantees, even before VC or alongside early days guarantees or seed capital, a little bit of grant can help. A repayable grant can prove the capacity of an SME or of a social project to prove that it can bring a little bit of repayment, if not all the repayment. It creates a statistic of repayments, and it creates then easier access to further VC, more mature seed capital, and eventually to the microfinance, and eventually to private sector banking, to start probably locally and then through DFIs and other agencies. So clearly, we would need more. We are present on the ground, but we would need more super good projects. We need more support for the great ideas that are very numerous in emerging markets, but that sometimes still need a little bit of grant, still need some guarantees and seed capital to have some progress. And with these words, I end my intervention. Thank you.
Mainstream, and I think you heard different type of answers. One, which is will be massive. It's not only happening in Europe, but in the US, even in China and a lot of emerging markets, is actually regulations. So the fact that the initial a bit of forerunners in impact investors, we heard a few this morning that were attempting to do something. Now it's also the time for regulators to pave the way for those new products, new vehicles, private equity, different type of loans, different type of bonds to actually reach mainstream market. So don't underscore the power of regulation, particularly as the smaller products which are driven by individual leadership, individual beliefs and very strong commitments actually become a bit of the mainstream of the market. So let us now move a bit before getting back to our colleagues online. Jean-Paul, a bit of patience. We go back a bit in the room now to get actually to African banks and to the commercial institutions that are actually operating in Africa already, that are doing deals. So it's a bit of what's your point of view? And I would start with Rabobank and Godfrey, if you would like to kickstart, and then we can pass to our colleagues. But give us your views from seasoned operator in Kenya and beyond.
Thanks, Max. Good afternoon, everyone. I think we are doing pretty well. When I look around the room, 97.5% of us have our two eyes open. 1% of you are seeing with one eye. We hope we can keep you with your eyes open. So, a specific question, what's our view as Rabobank? Now, as you probably know, Rabobank, we are through and through a food and agri bank. Very large in Europe, headquartered in Netherlands. We wake up and go to work because of food and agri, energy transition, and ornamental issues like flowers. Why are these issues important? There's already what's been mentioned about regulatory requirements. But away from that, what is it that we are seeing? And I'll just point out two facts. When you look specifically at Africa, the population we have today of 1 billion plus, in 2050, which is just a few years from now, 28 years from now, is going to be 2.5 billion people in Africa. Today, around 50% of the population in Africa are 20 years. And that means that all these people, if we were only to look at one fact, they are going to need to be fed, they are going to need to move about. Rural, urban migration, and food consumption. For us to be in a position to support financing that's going to go towards feeding these people, the issues of sustainability are extremely important to us. At present, any borrowing transaction that you're involved in has to be evaluated for sustainability. And I was just talking to one of my colleagues and I was saying, it's not the sustainability evaluation we used to do before, where you had tick box questions, you tick yes or yes, no. It's a very extensive evaluation. And because we are conscious that it's something that we have to get involved in. The other thing that we are doing is we are extending green loans to customers who meet our sustainability thresholds. And we continue being very committed. Let me stop there for now.
Thanks. And Davis, what's your view and stake on that? How is All Mutual and your work being impacted by those sustainability and impact considerations?
No, thank you very much. So I do concur with a lot of the speakers, what they've said. I think for us as All Mutual, I think what is important is that when you look at these ESG issues, it's not an aspect of what or if. We actually think it's a revolution that's coming. It's an aspect of when. And I think this will largely be founded by the fact that when you look at regulations in Australia, Asia, or even the United States, the SEC, the attention that the SEC is now giving to issue of ESG, what it says that this is a revolution, this is something that is coming. So as far as we are concerned as Old Mutual, is that this is a necessary aspect of our business that we need to do. Remember, we're in the business of insuring, providing lifetime insurance products to investors, to our customers. And as a result, it then becomes very important for us to talk about sustainability betas. It's important for us to have sustainable returns coming through from our investments. And as a result, as Old Mutual, we find that this is something that we have to do as Old Mutual. We can't afford not to be talking about ESG issues. And I think to show the commitment that we have regarding this aspect, what we have done is that in 2012, Old Mutual signed up for the UNPRI as an asset owner. And what then gone further to that, what we have done is that there's been an establishment of the responsible business policies within the business, where we are articulating quite clearly our commitment to the environment, commitment to the community, commitment to responsible investing, commitment to our customers, commitment also to our employees. And moreover, when you then go down in terms of responsible investing, so what exactly are we doing in that space? We've then gone and say, you know what, let's define our proxy voting policy out there. And it's out there, it's something that is in the public domain. And we've also said this is also our responsible investing guidelines. And why are we doing that is that we are committed to the issue of sustainability. We are saying that, you know what, the next investment that we're going to do, whether it's infrastructure, whether it's through funds, or whether it's through any of these investments, there needs to be the sustainability beta, because we are going to be there for a long time. And as a business, we can't afford not to be invested. We can't afford to shut our eyes and assume that ESG issues don't matter anymore. So I think as far as Old Mutual we are concerned, we are very much committed to this. We'd like to do much more in this space. And every way, it's the way that we do our investment process, the way that we look at investments, whether it's private equity, listed equity, you find that there is that ESG DNA embedded in it. It has become part and parcel of our decision making, part and parcel of how we look at investment opportunities. And I believe that going forward, I think the most critical thing that I think what Mutual would do would be to create that new Amazon effect, to simply say, you know what, because we are compliant, we are worried about these ESG issues, all our suppliers, you also need to start thinking about the same things as well. And I think this is something that I think it has been growing momentum within Old Mutual, to simply say, we can't be the lone voice out there talking about ESGs. Everyone else who's supporting our businesses should also be thinking about the same things, but this is instrumental, this is very fundamental to the way that we do business as a company. Thank you.
Thanks, and those are of course interesting aspects. I mean, to be also critical to the panel, a lot of those new vehicles and products actually are born because commercial banks do not reach, right, certain of, for different reasons, including the same that were mentioned, risk profile, size, ticket item, history, collaterals, you name it. But a lot of those actual products are born with also a gap from what is the current formal financial sector and what are the needs of enterprises. So the embodiment, the interaction of your institutions with also those nascent structures like impact funds and different type is very important but let's get on. You have a unique role, Pauline. You are actually the CEO of a foundation, so you're a steward within the bank ecosystem of sustainability and impact consideration. So what's your views and reflections on this topic and theme, and what is happening in Stanbic and in your organization?
Thank you very much, and good afternoon once again to everyone. Yes, the commercial banks are waking up, and I guess that's why some roles like ours exist, to try and bridge that. But just let me give you a bit of history about Stanbic Kenya and Standard Bank. So Stanbic Kenya is part of Standard Bank Group of South Africa, which is an institution that's 159 years old. So Standard Bank Group is entrenched in the continent. We believe Africa is our home, and we drive our growth. To be able to do that, we need to do a couple of things. Kenya specifically, we've been around for about 100 years plus, trading as Stanbic, trading as Greenleaf, and many others. What that has given us is very deep roots in terms of what can be done for the continent. Specifically on the issue of sustainability, we started by looking at what's happening globally. So we were one of the first signatories to the UN Responsible Banking Principles. We are also signatories to the Paris Agreement, and we've also signed to the South African NDP Agenda and the Agenda 2063. For us, we look at this whole thing of what can be done to bring it to mainstream from two levels. On one side, we have a framework that looks at the ESG side of things, and on the other side, we have a framework that looks at the sustainability part. On the ESG side, we believe that to mobilize capital, it is necessary to have effective governance and risk management processes. Of course, it is the commercial side of it. And on the other side, on sustainability, it's important to maximize the positive impact that we have. Now, coming closer home to Kenya, what is happening in the Kenyan landscape? We are very much regulated by the Nairobi Stock Exchange and the Central Bank of Kenya. Early this year, the Nairobi Stock Exchange launched the ESG framework. What that framework outlines is guidelines for a lot of the commercial institutions to follow if you're going to raise capital. What are the things that are stipulated in that? There's an ESG policy. So if you didn't have an ESG policy as a financial institution, there is a framework that's provided. They also outline the ESG management principles. They also look at code of ethics for institutions, people diversity, carbon footprints, data, cybersecurity, health and safety, and many others. Why are these coming as important at this time? It's because we are getting to that space where sustainability is becoming core to the way we do business. From where we sit on the sustainability, on the ESG side, on the governance side, what are the things we have done as an institution? We have very robust governance frameworks that are in place. We recognize that it is necessary to have effective ESGs. Why do we do this? Is because once we mainstream it, we are able to create the demand. Then secondly, as somebody did say in an earlier forum, it is an incentive for effective pricing. So from where we sit as an institution, it is important and it's imperative that we actually mainstream ESG, and it has actually been mainstreamed. Again, it also helps us minimize and mitigate potential negative impacts, especially when you're doing investments on the environment side. And then coming to the issue of SMEs and why this is important. In the Kenyan context, SMEs form a big part of our economy. It is a sector that cannot be ignored. It is a sector that we are playing through the foundation and playing that very well. And what are we doing there? Again, I will just echo what the colleague from the Société Générale said. We have gone into this sector in form of a PPP. So we are partnering with the national government. We've partnered with county governments in the Kenyan context to do a couple of things for SMEs so that they are bankable in the future. What are we doing? A lot of coaching and mentoring for these SMEs. We are creating revolving cards of catalytic funds that are going to be repayable. I think this was said very well by the lady from Société Générale. We are doing a lot of capacity building, and we're in the process of creating a fund to actually create pipeline and to make these SMEs bankable. Why are we doing this? Is because we believe these are the backbone of the economy. On the environment side, if I might just give an example, I think in one of the earlier forums, somebody did talk about the Aecon Green Bond. We were one of the banks that were behind the Green Bond. So again, there, what it does show is partnerships. FCDO provided the technical assistance for the affordable housing, worked with the government. As a financial institution, we came in and we were with Aecon when they were launching the bond in London. So there is a lot that is happening in the financial services sector. It is a movement that has begun, and it's a movement that cannot leave the SMEs behind. Thank you.
Thanks. And before getting to you, Tadej, let me get the perspective from Jean-Paul from Addis, I guess, and his considerations on the developments in the market, and then finally we'll hear about reflections from our friends at the development finance institutions. So Jean-Paul, would you like to unmute yourself and address the audience?
Thank you, Massimo. Can you hear me?
Yes.
Perfect.
Very well.
So greetings to everyone from Addis Ababa. And it's a great pleasure to be a part of this panel. I think we've already heard a lot of very interesting ideas, and I will touch on some of the same ideas, but from a slightly different perspective, and also introduce a few additional ones. Firstly, as you have heard, I'm speaking from the perspective of a development institution, the United Nations Economic Commission for Africa, and addressing the gaps that African countries have in terms of accessing financing from the private sector. And also speaking from the perspective of a country, I was working up until 2020 in the government of Seychelles, and I saw some of the challenges around getting sustainable finance to the countries that need it most. So firstly, let's understand the breadth of the challenge. There are less than 3% of the global financial flows that come from the private sector in the climate space that are going currently to Africa. That's even though Africa has about 27% of official climate finance through the UNFCCC process. And globally now, the majority of investment in climate resilience and sustainable development is actually being done through the private sector, but Africa is not keeping up. Also, in terms of the bond market, African countries have less than 1% of global green bond issuances. Now, this is situated in a context where African countries also struggle with domestic resource mobilization. There are very big budget deficits, which have been accentuated by the pandemic, but they existed even before. And there is a rise in debt, and there is the revenue relative to developed markets is very limited and is often dependent on a very small number of sectors, and very often directly linked to the export of raw materials, so maybe petroleum or minerals and so on. So this means that the African markets are often isolated compared to global capital markets, and this is one of the challenges. And there is also a lack of development of domestic capital markets. The growth model has more or less so far been around the export of resources. And I think what we're trying to do and what we're talking about is how do we invest and how do we get the private sector to invest to really change that market? And again, talking about the subject of blending, I fully understand the idea that we want to move away from it in the sense that we want a properly developed market. But I share the view as well that in the development of that market, there will be a very strong role for blending, particularly among countries that are very vulnerable. But I think it's very important to see the blending not simply as something which is done for the sake of that specific project, but it should be seen as a means of developing the market. And let's look specifically at the bond markets and the opportunity for African countries to access this type of financing. In terms of sovereign bonds, African countries are usually paying a premium because of the perception of risk, some of which, of course, is justified. But there is also a certain element of an African premium which has to be addressed, and particularly in the context of sustainable SDG-linked bonds or green bonds, we have to address the issue because there is not a perceived benefit now by the majority of African countries. When they've issued sovereign bonds, they have not actually received any benefit in terms of pricing. And I think if we look at the links, and I think a few people have already spoken about that if you do have a good investment strategy in terms of the use of proceeds, this will contribute to resilience. And therefore, there should be a reduction in the risk. But the market currently doesn't deliver this. And hence, we always end up going back to blending. But we need to, I think, through the idea of key performance indicators, which has been mentioned by quite a few people, we can actually structure the market and help to develop bonds which will, by themselves, actually be reduced in price. One of the initiatives that the ECA is leading is the development of a liquidity and sustainability facility, which essentially aims to create a repo market or repurchasing market for African bonds, which will increase the liquidity of those African bonds and therefore increase demand for African bonds, and over time lead to a compression in terms of the pricing. The key as well is that we have to ensure that this facility is linked to sustainable criteria. Speaking about the ESG criteria, because I think this is currently, from the perspective of countries, is often seen as a burden. And I think there is this importance of a harmonization of criteria. This has to be done through global processes because currently, each time a transaction is being done, different criteria are being applied, and this is very challenging for governments. There is an opportunity, I think, also in terms of at least sovereign bond issuances to look at the linkage with budgets, and again, through performance indicators. And the United Nations Environment Programme has been piloting green budgeting guidelines, which can be used by countries. And I think if we can align, if there is a global move on ESG criteria, and this can be aligned with budget processes, we can make significant progress. 2 points to conclude. One is on the need as well to address debt and to look at debt as an opportunity for investment. In many cases, we can refinance existing African debt, which may be fairly expensive in some cases, and refinance it with maybe additional issuances, with new financing provided, which can be directly linked through performance indicators to achieving SDGs or to achieving climate indicators. And so we talk about, and when I was in the government of Seychelles, we did a debt for climate adaptation swap. But I think the opportunity now should be really looked at in the context of capital markets and how we can help African countries restructure their debts, but using markets and using that opportunity to also link it with sustainable development criteria. And the final point is the opportunity for the development of carbon credit markets. Africa has perhaps one of the largest potentials for carbon sequestration. If we develop a high integrity market and strengthen the certification, and one of the pieces of work that the ECA is doing is about strengthening the opportunity for a high integrity registry of carbon credit opportunities in the Congo Basin. This can lead to the mobilization of additional resources. And this can be linked as well to other investments because it provides a very reliable flow of funds, which can be used to guarantee or to provide repayment for investment into priority areas such as agriculture. I'll stop there. I think there's been a lot of very interesting ideas that have already been shared, and I think this is absolutely a priority working with the SDG Fund on how we can channel more of these private sector investment into key resilience areas in Africa. Thank you.
Thank you, Jean-Paul. And we are in Kenya today. It's a fairly sophisticated market, indeed, in Africa, probably one of the most sophisticated, no doubt. But indeed, several of the countries, as beyond enterprises and financial institutions, are actually building products, new market, new capital market as we move. And the question, indeed, is how they can leapfrog from even some of the regulatory experiences in other countries in Asia. East Asia has been also one of the forerunners in terms of determining those roadmaps for integration of sustainability considerations into financial markets from the starting point. Virtually connecting with the previous panel and having the chance to have you here, Teddy, if you can give us a bit of a view from DFC and indeed the role of international financial institutions in steering the way and supporting, go along with financial intermediaries in creating these markets.
Great, thank you very much. I think in 1970, well before I was born, Milton Friedman is popular for saying that the only social role that corporations have is to maximize profits. So I guess we have come a long way now where such a corporation may not have space in today's world. And it's great, as everyone has alluded to, the sector has grown meaningfully, both in terms of capital, but also in terms of understanding of the need for having these requirements in our evaluation processes. Of course, there is ESG, which I would say is more of a compliance issue versus also impact, which is more intentional and is more, I would say, rigorous and more ingrained into the core business operations of any business or fund that call themselves impact investors. So there's a wide scale, right? So on the very, very left, we have the pure corporations that just want to make money. On the very right, we have, say, foundations that just give grants. And then in between here, the importance or the balance between profit and impact, shifts depending on where you're at on that scale. Nonetheless, what we agree on is that the sector has grown meaningfully. We have moved from the point where we're saying, is this important, to a point where it's clear in all our minds that it's important. And now I think what's key is now to focus on the how. And that's where I think DFIs could play a key role because right now, if you're a fund manager, for example, and you want to raise money from any DFI, you know exactly what is required from you as far as ESG compliance is concerned. Now, we need to graduate further and say now it's the how, I think a long time ago when companies such as Tala were setting up here, it was quite impressive that somebody who has no financial history can just get access to a loan. Right now, the discussion is not just that, it's also at what price are you getting this loan at? at how are you collecting these loans, that kind of thing. So I think these topics of the how become more and more important. And the DFIs at the end of the day, we kind of move the needle, especially for the capital, for the fund managers who require money from us, because when they are fundraising and we require, this and this and this, usually you would see that the current and the future fund managers would also comply with the same. So I think first of all, on our end, understanding a little bit more about the how, will be a good start. Before now, we can also start requiring it from the people who we invest in. I think there's still a lot to figure out in the sector as a whole. Of course, measurement still remains to be a key question. We have different entities that would try to come up with standards and the like. ISC's ESG is pretty good. The Global Impact Investing Network, UNPRI, etc. And I think credibility of such entities is important. I'm sure all of us have seen the debate going on as to ExxonMobil being listed as one of the top 10 companies in ESG, and Tesla not being on there. Of course, the jury's out there. I don't know who is better than who, but still, if we standardization of how we measure this kind of points is important for us to all have sort of alignment, at least in understanding. Finally, I think I'll just mention that whenever, as we all, and especially for us DFIs, as we all require that companies pay attention to ESG and impact matters, paying attention to the local context is important. At the end of the day, impact is subjective. One person could prioritize education, another person could prioritize, healthcare. And not that they're mutually exclusive, but just prioritization could be different. And so when we bring in foreign capital, are we really paying attention to what is key and what are the priorities for that particular country or region? I think that remains to be an important point to consider.
Thanks. And, I have a lot of questions for the panel, and we have a few colleagues here, but, I want to check the temperature in the room and want also to give our loyal audience a chance actually to ask questions to the panel. I know that unfortunately in the morning we were a bit late, so we didn't give a lot of chance. So before getting to a second round of questions to our panelists, I just wanted to open a bit the floor to the room. If you have any question, as you have heard, we have quite different perspective on the market from some European players and international players to very well-established institutions across Africa, active in Africa, as well as enabler like Jean-Paul and the UN and the DFC. So just opening it up for question, if you have any question to the panel. Oh, yeah, please. Oh.
Thanks a lot to our panelists for this exciting conversation. My question is because the conversation today is about SDGs and trying to mobilize, and I'm hearing a lot about the ESGs and how private sector works. But my question is about all what we're saying, how does it contribute to us achieving the SDGs? So what is it? Does it mean with all the regulation and everything, it makes our work easier as the UN, because we're looking at 2030, are we achieving those SDGs, and how do the way private sector works help us to achieve the SDGs? So that's a question to the panelists. Anyone can take it here.
Yeah, it's a very good question, which we'll report back. And just taking a couple of questions, just for getting back to our panel.
Yeah, thank you, panelists. It's been a really interesting discussion. Linked to my colleague in his previous question, for the SDGs to be solved, yes, some of it can be solved using commercial rate return solutions, but there's other stuff that may need, where the solution needs to address something where there isn't a commercially viable model, so that either returns might be sub-commercial or might require kind of different kinds of funding. What role do you see your organizations playing when that might be the case, or do you think that's up to somebody else?
Thank you. And let's start where you may think your other question. Let's start with those ones. I think the first one is also where everyone, I guess, in the room has the question. So I have a project or a company that has a very good impact and narrative and KPIs, and then I go to your bank, to your financial institutions, what does happen? How would you treat it? Would you treat it differently? Would you consider it differently? How would you prioritize it in your own lending? Do you have particular products as your green products? So let's start perhaps with the institutions in Africa here. So Pauline, Godfrey, or Davis, I'll give you the mic. He's here, and then we go back to other panelists, and also the other question from gentlemen. Indeed, what happens if this proposition has different terms, right? So, and how would you react to that? What will be your first reaction or advice to the sponsor and to the proposal? I know it's an easy question, so.
Thanks. You know, Mark Twain's famously said, a banker is a fellow who gives you an umbrella when it's sunny. And then when it starts raining, he picks up the umbrella. So I'll try and not be that kind of a banker in answering that question. Now, as a bank, the funds that we lend out is depositors' money. And so we are required by the regulators, CBK in Kenya, European regulators, that we take care of the deposits that we are holding. So if you walk through the door and you have a project which only has impact, but doesn't meet the commercial matrices, it's going to be difficult for us to do that. And so what we are doing now is combining the two, a commercially viable project, but also has impact. And some of the things that we are doing to move this conversation forward, whereas previously a customer would come, and I'll use an example of a player in the tea sector in Kenya and come and say, I want financing to upgrade my processing equipment, to do some civil works, and we would be happy to extend that financing. We're now getting to the point where we tell these players, can we also look at your production methods? Can we extend TA that people sit down with your farms and outgrower farms that supply tea to you and study how you're producing this tea and whether there's anything that can be done to improve productivity while we're also being sustainable. So in that case, once the tea has been done, we'll come up with several actions. And when we are structuring the financing, it then has a direct impact of what you're going to measure. And so my final really summary point is, it was said in the morning, you know, good ideas never lack money. But remember, as a bank, we have to make sure that the money is returned. And you know, as I digress a bit, some of you may have seen a note in the media today. So the Central Bank of Kenya has issued an 18-year infrastructure bond looking to raise 75 billion Kenya shillings, which is about 680 million US dollars at a rate of 12.96% tax-free. Now, that's a good investment, whichever way you look at it. But the converse of that then means up to 75 billion Kenya shillings is going to be redirected from possibly private sector activity and invested in the infrastructure bond. Why? Commercial banks are measured on return. The shareholders of these banks want return on capital, return on investment. But we are very conscious about that, and so we continue doing that. We have branded finance partners that we are working with to help us reach smallholder farmers. So technical assistance, where we realize that for a particular transaction, it probably is going to go beyond our mandate. We like lending money up to 7 years. Some customers may want money beyond 7 years to 10 years. We look for DFIs, or we look for branded finance partner that brings the risk down, risk mitigation, so that then we can continue and do that business.
Thanks, please.
Yeah, so it's a very difficult question. So someone approaches us as Old Mutual and they say, you know what, I've got a very good project. The impact is huge. So in as much as we are very cognizant of ESG and what we need to do to deliver on the SDG goals, I think what's also important, just like a bank that it's not their money, they would need the money back. We also are just custodians of people's investments. We are simply just mediums upon which we get funding for us to extend to people. And the expectation is that whatever investment that they've given us, they would want a return from it. And as a result, it's a very difficult conversation for us to say, yes, we like your project. Yes, it ticks every other box. But unfortunately, the issue about the returns is also quite critical to us, because we have got stakeholders, we've got a fiduciary duty to provide a return for those funding. But however, now through various investment instruments, what we have also been open to is the aspect of just bringing in funding from DFIs. So in as much as the project might not be very viable, but it's got a high impact, we are there to help get the project up to speed in terms of making sure that the E, the S, and the G are in place. Then what the DFIs would come in to do is either they give us guarantees for us to be able to work together with such institutions, or they'll give us first loss cover, or they're coming in with concessionary loans so we can have a fund whereby they're putting in money into those funds. It then allows us the flexibility to be able to say we've got the expertise to manage these businesses to get the sort of impact that is required. So allow us to play in that role, but we are not in a position for the time being to stomach the losses. So also let's then bring in the money which is able to do so. Let's combine with our capabilities, and then let's blow this thing up. So it's a difficult call. I would love for us to be able to fund every other project that comes our way, which has got no return perspective, but the monies that we are also managing, it's pension fund money. This is the money that you'd want to be there when you retire. So I can't say the time that you reach 65 and I come to you and I say, you know what, there's no return for you. But guess what, we did this high impact project. I'm not so sure what your view would be. But it would be so good for us to say, you know what, it is part of your investment, this is what we did. We still have got a return for you, but guess what, we've also made your life look much better because we've made these huge impact investments on your behalf. We can't do this alone. It's unfortunate, and that's the reality. We need the DFIs to come along us to help us in this journey. We are committed, but our commitment has got limitations that we need a return. At the end of the day. Yes, it could be suboptimal to some extent, but we can't stomach the entire losses that are usually associated with high impact projects, unfortunately.
So I'll be quick and try and answer both questions. So 3 years ago, Stanbic launched our women proposition, which is a DADA program, and we put aside 20 billion for that to support women-owned SMEs. What we learned is that the uptake of that was very slow. Why was the uptake slow? Most of these businesses were not ready for financing, as it were. So what have we done is that we have catalyzed, or we've leveraged other types of funding. So the bank has put aside a commercial amount, 20B. We realize there are certain issues that need to be addressed to improve the uptake of this money. So what are we doing? So we are talking to DFIs, we are talking to bilateral partners who provide grants, and we are doing a lot of what we call non-financial offerings. So your capacity building, exposing them to new markets, and all that. So what we've seen is that it's become very increasingly important that banks become also very innovative. I think it's on the back of that the Stanbic Kenya set up the foundation, because the foundation is able to leverage softer capital, and that softer capital is then used to de-risk and to create a pipeline that is more or less ready for commercial financing. So very soon you will see commercial institutions such as the FIs, the banks, coming up with SPVs. This is something that, again, is required, and I think Dr. Mwangi did speak to this in the morning. The banks have had to think differently. If you look at KCB equity and all these, they have leveraged, and they've managed to get new ways of supporting really the base of the pyramid. And the government, the Kenyan government, is quite progressive. The government is sitting with quite a number of guarantees. The government is, I think there's one that is funded by the World Bank, and they have quite a number of lines that support businesses in that sector. Now, to the question of SDGs, anything we are doing on the economic side of it speaks to at least 7 SDGs. On our side, we actually report to the SDGs. Any intervention we have, if it's the green bonds, if it's energy issues, what SDG are we speaking to? So if you look at what we call our report to society, which is really our impact report, we actually have an SDG for all the interventions. So banks are becoming innovative. Banks are responding to the global reporting standards.
Thanks, and particularly the role of banks that have large retail operations can be huge, because a lot of the limitations of private equity funds or wherever they are located, it's like they don't have boots on the ground. But indeed, if they retail, particularly banks that have huge retail networks, can actually be, as you said, Pauline, innovative in connecting with these different types of products and being a bit of assistance, if you wish, to the client into doing that, I think will be extremely important. And here we are not speaking about NGO projects. So I guess what my colleague said is actually business proposition, sometimes a bit of less than commercial return expectations maybe, but still a legitimate business proposition. Before getting for another round for colleagues in the audience, Massimo and Marie-Laure, do you want to add from your perspective on how would you answer the question? If not, colleagues, we'll have an opportunity for the last round of questions to the panel. Yep, please.
Thank you very much, and good afternoon. I think, and Jean-Paul also was at that meeting with UNECA just a week ago, and UNECA issued a very strong paper, but I was puzzled also by some figures. If you look at the lending to private sector over GDP, at least West African Economic Monetary Union that I know is 38%. Whereas in developed countries, it's 100 or 140. So meaning that even with what we have, we are falling short of that. The second, you have 385 billion USD in pension fund and 40 billion on sovereign funds. They are not invested in Africa. Even one country is saying, I have a ceiling on investment in Africa. This should be invested outside Africa. The third is what Jean-Paul mentioned. You have Greece and Ghana having the same rating, but Ghana paying a premium of 2.5% if they are issuing sovereign bonds. So the issue of rating, because this is an issue of conflict of interest, rating is not giving a public goods. These are looking for increasing the profit of private institutions. So there was in 2013 a document issued by Intesa looking at how we could have more aspect on this rating, because it's a concentrated business. Free rating agencies are rating 99% of the sovereign bonds, and we know them. So that's an issue that we need really to tackle. These are global issues on the architecture. Second aspect, which I think we as Africans, I'm a UN, but here I'm talking as an African, we need to tackle is the issue of how we are tackling illicit financial flows. We have 83 billion illicit financial flows, which is 1.5 the ODA, which is 55 billion USD. How do you make sure that you tackle the illicit financial flows to make sure that is injected in the economy to achieve the SDGs is important. The third, and I will end with this one. I have so many things to say, but I said it during the high-level panel to which I was during the UNECA things. The third thing, which is important, is we have a very low lending to capital, even if with the same equity. With the same equity, our regional banks and our bank is lending 2 to 3 times less than the other banks, than other regional banks. You know, the Asian development banks, they have lending to equity 17. Some have 13. We are between 2 to 5. So it means that with the same equity level, we could have done more, 3 times more than what we are doing. Last point is the remittances. If you look at the Africa structure of the financing, Africa is financing itself. because revenue and the savings and the remittances are more than 80% of the financial structure of Africa. So it's important that we also change the narrative, look more inward, how we use the remittances, not to inject it in social aspect, but to invest it in economic aspect. But there we have a battle to do. So to transfer currently, Africa is paying 70%. The SDG is saying that in the goal 17, we need to move from 7% to 3%. So here again, we have an advocacy and a role to play in supporting as UN that we create a global financing architecture, which will be enabling the environment of using all the tools that you mentioned. Thank you.
Hello, my name is Irene Gadieka from Total Impact Capital. Mine is a very brief one, and it's to Massimo. I heard one of your points that you made was that we should make the deals that seek financing to be deal ready or solid and avoid relying on guarantees. But what effectively my interpretation of that means is that you will leave out most of your panelists because they have just argued that their money, they're custodians of the money that they lend out, so they cannot take that kind of risk. So if we consider doing away with guarantees, then are we not weakening the markets because the few people that have dared to lend into this market will not consider doing it anymore? What's your view to all the panelists?
Thank you, colleagues. I'm not sure if I see any other end, and I think we are also reaching the end of our panel. So I will give actually a chance to the different panelists to also, while responding to the last two questions as well, to maybe share their final thoughts, maybe one or two thoughts about how, what they think as the main levers to indeed move from niche to mainstream. So if they would think of one or two things that would be critical. And I think Fodder mentioned some of the macro aspects about the actual, the capacity of the local market to leverage existing assets, to price existing assets, and indeed to penetrate into what is actually also people savings and people financial literacy. So I think some of those questions are more of a macro level, and then we have a second question more about the play between where to put the boundaries between what is blended, means what is adjunct with public guarantees involved by the FC or other players, including the joint SG fund, and where this should not should be leveraged out and then be allowed just market to operate. So Massimo, maybe you can start, but also as we are moving out to the closing, any final thoughts on the panel and the discussion on that we had today for any final remarks. So over to you.
Yeah. What I meant is that you should be able to have, let's say, the example of a bond issue which arrives at the investor's point based on its credit risk, not based on the guarantee, which is a totally different credit risk. So if you really create a fund which shows that it's doing well, it's investing in a correct way, at the end, you should arrive at a point where the fund should be financed directly without any additional guarantee. I do not know whether I answered your question. I cannot hear.
She says she disagrees, but that you answered.
Okay, but we can continue our conversation later.
Any final thoughts as well, Massimo, on the panel and the discussion that we just had? Because we are
No, not really. I would like to know what you think about the idea of having a cooperation, because this is, my opinion, is the most important aspect which came out of also this morning's panels. Lack of cooperation, if I well understand. I think it's a very common problem. Now, how can we address this? would it be possible to launch a plan to address one or two issues which are very important with the total cooperation?
Well, you will something that you will please as we move, and then we'll go back, Jean-Paul, and please be patient, and also as well for your final consideration and answer to the question. Actually all our programs here, our colleagues have the unique role to do this type of work, to bring together all mutual with the government, with the different partners, with the UN, with the development bank. So we hope that those that are mostly national networks, like the one Arif and is leading here in Kenya, actually can be the promoter of more international and regional cooperation. And then Jean-Paul, maybe you also have some thoughts from a regional perspective. But let's get on with our panel, with our either response to the questions or final consideration. Maybe just 1-2 points, summary points that you think were essential out of this discussion today.
Thanks. And I think I'll mention something about sustainability of investments. It's important that whenever we are using de-risking tools, at least even for us as DFIs, we want to see that the client will no longer need these tools in the future, essentially, because it cannot be sustainable perpetually for us to provide grants or for us to provide guarantees. So I think it's important to consider the financial sustainability of a particular project or initiative as even as we begin in the initial stages. And to wrap, I think just say that for institutions such as us, financial innovation is moving fast, technology is moving fast. So it's important that we also shift our mindset and continue taking on that catalytic role, let me say, in this financing stack. Now that the private banks are coming into the ESG space, the impact space, we who can stomach higher risk can no longer be playing in the same space. Otherwise, discussions such as DFIs crowding out local capital start to arise, right? So we need to still now take another step back and probably do even the riskier level for us to continue catalyzing more impact. As you know, we at the DFC continue to sort of innovate and try to add more products. We issue guarantees to a lot of the banks. We also issue insurance to some of the private investors getting into markets where they deem to be higher risk, and we basically insure them against the risks that they fear, such as expropriation or currency inconvertibility and the like. So we hope to continue playing that role, and we hope that more capital can continue to be channeled into the ESG and impact sector, especially here in Africa.
I'll go to final thoughts. So when I came in the morning and we were introducing ourselves, I happened to meet one of your senior colleagues, and she told me, "Oh, you from the bank, so you have all the money." And I said, "Perhaps." And I told her, "You're from the UN, so you have all the influence and you can open any door." And that would probably be my closing point in saying that in this room, there's a lot of knowledge on impact, a lot of knowledge on how to get things done, a lot of networks and influences at the right place. On the other side, as commercial bankers, we still have the funds, yes, we are still in our old ways of credit risk and financial risk. Both of us are heading in the same direction, but we are moving in parallel. So the sooner we can make a convergence, I think the better, in terms of how do we actually start co-creating, as Dr. Mwangi said in the morning, solutions that actually address the financing gaps that we are mentioning here. Because we have the knowledge, I think it's going to be spoken even tomorrow and the day after tomorrow about what can be done, what we think we have seen working elsewhere, but how do we come up with these solutions that start addressing these funding gaps and financing gaps that we are seeing? Thank you.
Yeah, so I think I also go to the just the final thoughts on it, and I think this I think what's important, number one, is to consider that this is now a new normal, and I think people now need to start considering new sustainable assets. And what it means is that we also need to look at different ways of measuring returns. So this applies even to us or even to the banks. We might be measuring value the wrong way for us to be able to achieve the SDG goals. maybe what we are considering to be important is not as important as what the world will look like 10 years or 20 years from now. So I think that's the first consideration. Then the next one is that I think we've been talking about these financial instruments, and there are certain instruments that are provided by your DFIs. Now, and clearly what's also happening is that we are really moving, as what my colleague has said, we are really moving in parallel. Yes, we have got the same agenda, but we are just moving in parallel, and we are not really converging. And so for us to converge, then it then becomes necessary for us to actually to have innovative financial instruments that really talk to the challenges that we have. For now, we are still talking about the traditional assets, the traditional instruments. No one is talking about the innovative, because the world is as different as it was. It's not as same as it was back then. So surely we should have innovative financial instruments that then come in to really answer the question that we currently have. Then the third aspect for me is that I think the future role of DFIs is largely of a catalyst. They should come in, they provide the catalyst role, and then what then becomes quite important is the handover mechanism to simply say, we have come in, we have done our part. We are now handing over these investments to the private sector for you to be able to take them to the next level. And I think that is also very important, because what it says to me is that the private partners, the private sector and the DFIs, they are not talking, they are not sharing deal pipeline. The deal pipeline that the DFIs are looking at is being considered as if it is just exclusive only to DFIs, and it's not something that the private sector can look at. So my view is that I think there is greater need for collaboration, greater need for cooperation, for people to be able to share deal pipelines, for people to be able to hand over opportunities to say, we've done our catalyst role on this investment. We think that is now up to the Rabobank, Stanbic, or Old Mutual for you guys to take it to the next level. That aspect is not happening. For some reason, people are not sitting at the same table and having to discuss these issues and get a solution to them. Thank you.
I think on my closing remarks, and maybe this will answer some of the questions on that were raised in terms of what Africa is doing. I think this morning we were speaking about public-private partnerships. And in this room, we have the UN that has the convening power. We have the private sector, and we have the civil society, I believe. And what I'm missing in the room is public sector. Now, some of the discussions that have been brought, the last issues that were raised, could easily be solved if an institution, and Arif, I'm looking at you, like UNDP was able to convene the government and the players in this room. We are moving ahead of the policy framework, if I may call it. Our government colleagues need to come along. In my old days in the UN, we used to second expatriates to work at Treasury and a few other places where these decisions would take place. I think that is still something that would add a lot of value. We are talking a language that is not understood. They very much look at the documents when you start speaking about remittances. In Kenya, I've seen we are thinking of coming up with a diaspora bond. I think it's already there. How are we taking this narrative, and who understands it, so that the enabling environment then comes in to look at other issues like the illicit financial flows and this low lending to capital? There honestly is a business dialogue, and the UN has the convening power to pull the partners together through the SDG platform and say, these are the issues coming. If we are to mainstream this whole narrative of innovation, ESG, and sustainability, UN, honestly, I believe has, in Kenya, we have the right platform to do that through the SDG platform.
No pressure. Thanks. And let's get to our colleagues online who were very patient. Maybe Jean-Paul and then Marie-Laure. Jean-Paul, please, also your final reflection, as we are a bit running out of time, and also try to respond to questions. Thank you.
No, thanks so much. I think that for me, the main, maybe indirectly answering the question, but also my takeaway is that we need to deepen African financial markets, both in terms of the development of those domestic markets, meaning building on the examples we've seen in Kenya. You know, there are domestic bonds, there are perhaps more access to different types of facilities for investment in SMEs and so on. We've heard a few examples. But we need to have this developed across the continent, and we need to look at things like blended finance as a means of stimulating that. I think even when we've looked at developed markets in Europe, for example, there have been at various points, various instruments that have been deployed to develop certain sectors. And I think in Africa, we need governments to be proactive in developing those elements, and there needs to be support from development institutions to create that ecosystem of facilities which allows finance to be channeled to where it's needed the most. Of course, there are, and I think we do have to recognize that in Africa, quite often there are things that end up with bankers or that are put forward for financing as private sector projects because there is a gap in government infrastructure or there is a gap in government services. And I think we have to recognize that we can't substitute for government through these roles. There has to be an understanding that there are certain types of activity which have to be undertaken by governments. But I think it was said very, very clearly that where there is clearly a return on investment, then this should be an opportunity to actually develop the private sector and develop the mechanisms that allow the private sector to build that domestic market. And this will create, it will take some time, but it will create a virtuous circle because you will develop the domestic capacity as well for resource mobilization. And we move away from a purely extractive model of an economy based on exports of raw materials towards more of a value addition and type of economy built on sustainable value chains. But you need to channel that investment. Without that investment in the first instance, then you don't get to that scenario where you can deepen and develop the markets. Thank you.
Thank you. And Marie-Laure, you want to also share any final thoughts and reflections out of the discussion and your experience?
Thank you, Max. I think there's been a lot of ideas presented. At the end of the day, all of the ideas are probably very complementary to each other. We each bring something to the table, whether it's money or whether it's just door opening sometimes, or political play. It is very complementary, and it's not purely a chain of events that you go from a grant receiving entity to a full-scale international company. It's sometimes a multi-layer approach that you need to have an overlay between your grants and your access to some external funding, and your access to DFI, and your access to banking, and potentially your access to capital market. It needs to be done not only step by step, but very jointly. And honestly, I had a great admiration and great attention to what my colleague from Stanbic said. Very, very interesting approach to really help the SMEs getting from grants, but still getting grants, to access to some money. Even if it's not a bank's business yet, it will be the bank's business of the future. Therefore, it is worth the investment today. And that's typically the illustration of this multi-layer approach at some point, that suddenly someone shouldn't get any grant anymore and go for a full banking loan. This is not going to happen. And some of the people around the table are also bringing these intermediary tools so that we all work together towards stronger SMEs and companies in Africa and elsewhere.
Thanks, colleagues. This concludes this panel. We have heard a lot of ideas, and of course, this is a discussion. As many colleagues pointed out, cooperation, collaboration, and partnership is a key area. As the Joint SG Fund, that is what we support. We support our UN agencies in leading this work, our resident coordinators to establish platforms, to establish dialogues like this one today that we hope may be replicable to other countries. But let us now give a round of applause to our distinguished panelists and thanking them for their time, for being with us. Also, as I give back the floor to Vicky for the announcement, now as we started the day, we need to start to look much more in details on doing what to do. And that's what is about to happen in the next session that we'll have this afternoon and tomorrow morning. So we'll discuss very practical cases, very practical solutions that are specific sometimes, but also replicable and scalable in other countries. So that's where we hope to have much more interaction with the speakers and among your audience to discuss practical solutions that can work in Africa. So we hope you will join for our next sessions, which are along the themes of the day: food, energy, and social impact. But Vicky, over back to you on the next on the plans for the remaining of the day. Thank you.
Thank you, Max, and another round of applause for the amazing panelists. You may now have your seats. Thank you. So I hope our energies are still there. Maybe if you're having a good time, say, oh yeah. Oh my gosh, we just had lunch a few ago. Please, a bit of energy. If you had a good time, say, oh yeah. All right, we're hoping tomorrow the oh yeahs will be better, but glad to hear that. So we're now winding down the discussion, but building up the pace for tomorrow. So this is just a tease of what's to come tomorrow. So you better come tomorrow. That's what I'm trying to say. But we have 3 breakout sessions now, and the first one is on investing in energy access. And the moderator is Joanne Manda, the climate change and innovative finance specialist. So Joanne Manda, if you're in the room, could you please raise your hand and wave? Joanne? All right. So if you are interested in doing a deep dive on energy access with case studies from Madagascar and Zimbabwe, please follow Joanne. Right next to the pool, you will see a tent on your right. It's called Cheetah. That's where the breakout room will be. Then we have a second one called social impact, where we'll really be narrowing down to human well-being and health, looking at practical case studies from Ghana and Rwanda. And the moderator for that discussion is Samuel Godfrey, the regional advisor for WASH, UNICEF. I don't know, Samuel, might you be in the room? Just give us a wave. Oh, Samuel is already all set. So if you're interested in that discussion, head down to the tent near the pool, but now on your left. It's called Leopard. Then we have the third one and the final, but definitely not the least, on food systems and agriculture, right here in the pavilion. And the moderator for that discussion is Malena Rosman, Senior Advisor on UN Financing, and she's already stood and waved. All right. So maybe we can give ourselves a few minutes to move to the respective rooms. I see Joanne is already on the move, so those interested in energy access, Madagascar, Zimbabwe, please follow Joanne. For those interested in social impact, Samuel is already ready for you in the tents. Leopard, breakout room 2. And food systems and agriculture, Malena is ready for us right here. And for our colleagues who are joining virtually, there are separate links for each breakout room that have been shared with you. There's one for energy access, one for social impact, one for food systems and agriculture. Thank you, colleagues.